This is the moment crypto becomes more than just a speculative asset, because starting now, digital currency is being approved as legitimate collateral for one of the biggest debt markets in the world, housing. That's right, crypto is moving into mortgages. It's already happening, and the institutions behind it are far bigger than you'd expect. Let's break it down. This month, one of the largest mortgage tech firms in the US confirmed it is piloting a program that allows custodied crypto to be used as loan collateral. That means you can borrow against your digital assets to fund down payments, secure home equity lines of credit, or even qualify for jumbo loans, all without liquidating your crypto. And this isn't just DeFi, it's driven by regulated banks with real access to mortgage markets. So why now? Why is crypto suddenly being allowed into the most conservative corner of the lending world? It comes down to one thing: institutional custody. Until recently, banks wouldn't insure crypto for mortgages. That's changed. Thanks to custodial platforms like Fidelity Digital Assets, Coinbase Prime, Anchorage Digital, and even new infrastructure from Nasdaq, financial firms can now custody Bitcoin and Ethereum in ways that meet regulatory and insurance standards. Now, lenders can treat crypto like any other security, verifying, locking, and even margin calling it when needed. And suddenly, crypto becomes a usable asset, not just a volatile position. Now here's where the real disruption begins. The average American homebuyer in 2024 faced a 30-year fixed mortgage rate of 7.25%, the highest in over 2 decades. That pushed monthly payments to record highs and made traditional borrowing less attractive. But crypto-backed loans flip the script. By collateralizing Bitcoin or Ethereum, borrowers can unlock loan-to-value ratios of 50 to 70%, sometimes more, depending on asset stability. That's enough to unlock financing without touching your crypto. The loan itself can be interest-only, deferrable, or structured creatively, and in some cases, it can bypass credit scoring entirely. That's a seismic shift in lending criteria. It lets younger investors leverage crypto without selling or triggering taxes. But this isn't just about helping crypto holders buy homes. This is about something far bigger: the merger of digital and traditional finance. We're now watching the birth of hybrid underwriting, a system where your crypto wallet, tokenized equity, or stablecoin yield history could carry the same weight as a W-2 or credit score. And the implications of that are massive, because this opens the door for decentralized identity, real-time income verification from blockchain activity, and even tokenized real estate itself to become part of the mortgage underwriting stack. Here's the twist: it's not just small firms experimenting. This month, the Federal Home Loan Bank of San Francisco published a research memo exploring crypto asset collateralization in housing finance. And quietly, several fintech mortgage originators are already integrating APIs from digital asset custodians into their risk models. And it's being paid with real money. According to Galaxy Research, over $6 billion in Bitcoin-backed loans have already been originated in private markets. That includes everything from business loans to real estate, issued by players like Ledon, Unchained Capital, and BlockFi before its collapse. The difference now is that regulated mortgage banks are entering the field, not just crypto lenders. That means this market is about to explode in legitimacy. Now let's pause here and ask a more important question. What happens when Bitcoin becomes embedded in the housing system? Because housing is not just a loan market, it's a systemic pillar. It underpins bond markets, securitization, property taxes, municipal financing, even GDP. If Bitcoin becomes a funding mechanism for home purchases, it becomes embedded in economic velocity. That changes its volatility profile. It could reduce sell pressure during bear markets and increase institutional demand during bull cycles. It also creates cross-system dependencies. If crypto prices fall too far, borrowers may face collateral calls. That introduces new risks, but also builds bridges that didn't exist before. And that's where the open floodgates begin. We're already seeing real estate platforms offer tokenized equity lines, where a portion of your home can be digitized and borrowed against via smart contracts. In the next phase, those tokenized home assets could be paired directly with stablecoins or yield-bearing DeFi protocols. Imagine earning rental yield from a fractionalized home in Florida while using your Ethereum to post margin on a mortgage in California. This is where finance is going. And the institutions are not just watching, they're building. BlackRock recently announced an expansion of its digital asset strategy to include tokenized real-world assets, including real estate. Franklin Templeton, one of the oldest fund managers in America, now offers a U.S. government money market fund on blockchain. Meanwhile, the U.S. Office of the Comptroller of the Currency has quietly issued guidance on crypto collateralized lending, signaling that banks can participate as long as proper risk controls are in place. In other words, the door is open. And here's the part most people will miss. The reason this matters isn't just that it helps crypto holders get mortgages. It's that it puts crypto inside the most politically sensitive, economically important, and systemically protected asset class in America. Housing is too big to fail, and it's being rewritten. And if Bitcoin is accepted inside that system, even in small doses, it gains indirect access to the very safety nets designed to protect it. It means regulation, insurance, and long-term integration. It also means the first irreversible step toward making crypto part of the core monetary system, not just an outside alternative. So how far away is this future? Not far. We already have Bitcoin-backed mortgages in California, Ethereum collateralized bridge loans in Texas, and hybrid asset credit lines being underwritten in New York. The smart money is positioning early because once these pipelines are built, they tend to scale fast. Crypto holders won't just be investors, they'll be participants. The line between digital and real-world assets is being erased, and what comes next isn't speculation. It's integration. If you want to stay ahead of this shift and understand how the next financial system is being built under your feet, subscribe now. Because by the time the headlines catch up, the opportunity won't just be gone. It'll already be priced in. Another reason this shift is accelerating is being overlooked. Wall Street is running out of yield. With bond markets volatile, equities overvalued, and real estate becoming harder to access, institutional investors are hunting for new collateral layers. Crypto, especially Bitcoin and Ethereum, are increasingly seen not just as risk assets, but programmable collateral. This gives banks a new sandbox to work with. For example, if a borrower has $500,000 in Bitcoin and wants to purchase a $1 million home, they no longer need to sell their assets. Instead, crypto can be locked in custody, untouched with lender recourse. These transactions now approach real-time execution. More importantly, it's opening up opportunities for people who've been traditionally excluded from the mortgage system, including the self-employed, the crypto native, and international investors with clean capital but no domestic credit file. Underwriting may evolve from paperwork to digital wallets and on-chain data. If you want to stay ahead of these shifts with real-time insight before the next wave hits, make sure you subscribe. Because when the system resets, those who saw it early won't just survive, they'll lead.